If you have a terrible credit score, traditional banks will basically just slam the door in your face
Yeah.
before you even finish sitting down in the lobby.
Oh, absolutely. They don't even want to hear the story.
Right. But you can pull out your phone right now, scroll for maybe 30 seconds, and you will inevitably find a flashy ad for a platform like Enable Loans.
Yeah, they're everywhere.
Literally everywhere. And they're promising to drop, I don't know, $900 into your checking account in under an hour. And the banner always screams the exact same impossible claim, which is no credit check.
Yeah, in massive, bold letters.
Exactly. And in a moment of total panic, like maybe your transmission just dropped out on the highway or your kid needs an emergency dental procedure, I mean, that sounds like a literal miracle.
It does, and it's a brilliant piece of, psychological marketing because it targets you exactly at your point of maximum vulnerability.
Right?
The promise of zero friction, of just completely bypassing the very system that has rejected you in the past, it's an incredibly powerful hook.
It's irresistible.
It really is. But the reality of what actually happens the moment you hit submit on that application is, oh, well, it's a massive, highly complex machine operating right behind the screen.
So, okay, let's unpack this.
Yeah.
Because the goal for today's deep dive is to look at a stack of financial advisory notes and decode the actual plumbing of this system.
Which is fascinating, by the way.
Oh, it's wild. We need to figure out what no credit check really means, how these online loan platforms actually operate, and frankly, the hidden math you need to understand before you go and type your social security number into some random web form.
Yeah, you really have to know what you're doing.
Right. So to figure out if these lifelines are legitimate or just a trap, we first need to look at the entity on the other side of the screen. Like when I click apply on Enable Loans, who am I actually borrowing money from?
So in the vast majority of cases, you are not borrowing from the platform you just clicked on.
Wait, really?
Yeah. A company like Enable Loans, they are not a direct lender. They don't have like a giant vault of capital sitting around.
Okay, so what are they?
They're a loan marketplace, which essentially functions as a digital lead generator.
Got it.
Their entire business model is built around acquiring your application and immediately distributing it to a large, completely hidden network of third-party lending partners.
I've heard this described before as a dating app for emergency cash.
A dating app.
Yeah, like you put your profile up and wait for lenders to basically match with you. But honestly, looking at the mechanics here, that feels a bit too romantic.
It really does.
It sounds more like tossing a piece of raw meat into a shark tank.
Yeah.
You are blasting your financial desperation out to this massive network and just seeing which subprime lender bites.
Yeah, the mechanics are definitely closer to a reverse auction or what the industry calls a waterfall system.
Oh, waterfall system, how does that work?
Well, when you hit submit, your single application is instantly routed through an API to dozens of independent lenders all at once.
Wow.
And these lenders, they have algorithms just standing by to evaluate the data you just provided. The marketplace software essentially cascades your application down a list of these partners.
So it's bouncing from lender to lender.
Exactly. If lender A passes, it goes to lender B, and so on, until one of those algorithms decides your specific profile actually fits their risk appetite.
I mean, I will say the convenience factor there is undeniable. If I'm trying to figure out how to pay like a massive plumbing bill by tomorrow morning, the very last thing I want to do is fill out 20 different loan applications on 20 different clunky websites.
Oh, for sure. No one has the time or the mental bandwidth for that in an emergency.
Right. So a marketplace model consolidates that entire process. If multiple lenders decide they want my business, I theoretically get to see all those offers populated in one clean dashboard.
Yeah, and that consolidation is absolutely their primary value proposition. It drastically reduces the friction of comparison shopping for you.
Which is helpful.
It is. However, the mechanism creates a really dangerous false sense of security. Because the platform's marketing is just so aggressive and omnipresent, borrowers often assume the platform itself is underwriting the loan.
Right. You think Enable Loans is the one approving you.
Exactly. And therefore, they assume approval is highly likely. But the reality is that the marketplace guarantees absolutely nothing.
They're just the middleman.
That's all they are. You are casting a very wide net, but those independent lenders on the back end, they are under absolutely no obligation to offer you a single cent.
Which brings up, I think, the biggest plot hole in this entire operation.
Okay, let's hear it.
If my application is being fired off to 50 different lending algorithms,
Right.
and those algorithms are making literally split-second decisions about whether to risk their capital on me, how are they doing that without checking my credit?
Ah, yeah.
Like, the math just doesn't add up. You cannot evaluate financial risk without looking at a track record.
Well, what's fascinating here is that you've just hit on the core illusion of the entire industry.
Ugh.
The phrase no credit check is a complete masterclass in calculated language. When a consumer reads that, they interpret it as no financial vetting.
Yeah, that's exactly what I'd think.
Right. They assume the lender is just flying blind, taking this huge leap of faith based on a promise to repay. But the technical truth is that the lender is simply performing no traditional credit bureau check.
So they aren't, like, pinging Experian or Equifax to look at my actual FICO score.
Correct.
But they are absolutely vetting me. It's just a credit check by another name. I mean, honestly, it sounds like pure marketing spin.
It is marketing spin, absolutely. But the underlying technology that's replacing the FICO score represents this massive shift in how the financial sector evaluates human behavior.
How so?
Well, these lenders are relying on alternative data streams. So instead of looking at a three-digit number that summarizes your past decade of debt repayment, they are plugging directly into your immediate financial reality.
Okay, what does that actually mean, though?
They evaluate three primary metrics. They look at robust input verification, granular employment history, and most importantly, they do a deep analysis of your recent banking activity.
Wait, hold on. How does an algorithm analyze my banking activity in the, 10 seconds between me hitting submit and a loan offer appearing on my screen? Are they hacking into my Chase account?
No hacking. They actually require you to grant them access.
Oh, wow.
Yeah, usually through open banking protocols or third-party integration software like Plaid. You basically log into your bank through their portal, which grants the lender's algorithm read-only access to your transaction history.
That feels incredibly invasive.
It is a lot of data.
Ah.
And the software scans your last 60 to 90 days of activity. But here's the key. It isn't looking for, say, a missed credit card payment from 4 years ago.
Right.
It is scanning for very specific behavioral markers right now.
What kind of markers are we talking about?
Well, it looks for the consistency of incoming deposits, to verify you actually hold a steady job.
Makes sense.
It calculates your average daily balance to see if you're constantly hovering dangerously close to zero. It scans for non-sufficient funds fees or NSF fees.
Basically checking if you bounce checks a lot.
Exactly, because that indicates you frequently overdraw your account. And it looks at the overall ratio of your incoming cash to your outgoing obligations.
So they're completely ignoring my historical risk and focusing entirely on my present liquidity.
Yes.
Because, I mean, a traditional bank looks at a bankruptcy from 3 years ago and just denies me on the spot.
Immediately.
But this alternative algorithm looks at my checking account, sees that I have, a paycheck clearing every other Friday and maybe a couple $100 left over each month, and decides I have just enough cash flow to handle a new monthly payment.
You nailed it. The entire paradigm shifts from historical creditworthiness to immediate cash velocity.
Cash velocity.
Yeah, and that is the fundamental mechanism that allows someone with a completely catastrophic credit score to secure a $900 loan in a matter of hours.
Right.
The algorithm determines that you, the borrower, have the physical cash flow to service the debt today, regardless of how many bridges you burned in the past.
Okay, so that perfectly answers the how. But frankly, the why is what terrifies me.
Oh, I know where you're going with this.
Right, because the lender knows I have a terrible credit score. Otherwise, I wouldn't be clicking on an ad for a no credit check loan at 2 in the morning.
Exactly.
They know I have zero leverage. They have quite literally peered into my bank account and seen exactly how desperate my cash flow really is.
They see everything.
So when that approval screen finally pops up, the cost of that money has to be just astronomical to offset the massive risk they're taking on me.
Yeah, and the cost is where this business model truly reveals itself. The speed and the accessibility, that's just the bait.
Right.
The back-end fees are the hook. The analysis of these loan agreements in our source material points to 4 distinct variables that every single borrower absolutely must scrutinize.
Which are?
You have to check the interest rate, the origination fees, the total repayment amount, and the actual viability of the monthly payment against your real budget.
Okay, I really want to focus on those origination fees and the interest rate, because the literature we are looking at features a very stark warning, which is that a small loan can quickly become much more expensive than the actual problem it was meant to solve.
It happens all the time.
And reading through the mechanics of how these fees are applied, it instantly reminded me of buying a printer at an electronics store.
Okay, walk me through the printer comparison.
All right, so you walk into a big box store, right? And you see this sleek, brand new printer on sale for 50 bucks.
Seems like an impossible bargain.
Exactly. It's so cheap, you buy it, you take it home, it solves your immediate problem.
Right.
Then, maybe 3 weeks later, the starter ink runs out. So you go back to the store, and the replacement ink cartridges cost $75.
Oh.
The ink literally costs more than the machine. And you have to keep buying it over and over again just to keep the machine functioning. You just get financially hollowed out by these hidden recurring costs.
It's a trap.
Exactly. And these emergency loans operate on the exact same logic. The $900 you borrow to fix your transmission, that's the cheap printer. The origination fees and the triple-digit interest rates, that's the printer ink.
If we connect this to the bigger picture, the analogy holds up particularly well when you look at how those origination fees are structurally applied.
Okay, break that down.
So an origination fee is basically an upfront charge levied by the lender simply for processing the application and deploying the funds to you.
Like an admin fee.
Exactly. And it is often calculated as a percentage of the total loan. But here's the critical mechanical detail that people miss. That fee is usually either deducted directly from your loan proceeds before the money is ever wired to you, or it tacked onto the principal balance immediately.
Wait, explain the deduction method.
Yeah.
If I'm approved for a $900 loan, and let's say the origination fee is 15%.
Which is $135 just to do the math.
Right.
The lender does not actually send you $900. They send you $765.
Are you kidding?
But your loan agreement, the balance you are now paying interest on, is still $900.
So I don't even get enough money to actually pay the mechanic in full, but I am instantly in debt for the full amount. That is brutal.
It is. Or, conversely, they might send you the full $900, but they instantly add the fee to your principal.
Meaning?
Meaning, your starting balance on day one is $1,035. Add in an annual percentage rate that can very easily exceed 100%, and the cost of the ink rapidly dwarfs the original capital.
That's insane.
By the time a borrower finishes paying off a $900 emergency loan over, say, a 12-month term, they might have paid $2,000 in total.
But the lender relies on the fact that when my car is trapped in a hydraulic lift at the mechanic shop, I am suffering from extreme tunnel vision.
Oh, absolutely.
I am not sitting there doing the math on what this loan will cost me in November. I'm only looking at whether this injection of cash will get my car back on the road by 5 o'clock today.
Because panic completely destroys long-term financial reasoning. The brain in crisis mode prioritizes immediate survival over future stability.
Human nature.
Exactly. And the entire interface of these marketplaces, the bright colors, the countdown timers on the loan offers, the really smooth, frictionless slider bars, it is all engineered to capitalize on that exact tunnel vision.
Wow.
That is why evaluating the total repayment amount before signing the digital paperwork is the single most important defensive maneuver a consumer can execute. You absolutely must calculate the cost of the ink before you take the printer out of the box.
Okay, but let's play this out realistically. Say I pause, I step out of the panic, I read the fine print, and I see a $200 origination fee and a 150% interest rate.
Okay, good. You read the fine print.
I realize the loan is financially toxic, and I refuse to sign.
Yeah.
But, I mean, the emergency hasn't vanished. The mechanic is still standing there demanding payment.
Right.
What is the actual way out of this trap? Because our source material lists several alternative options, and honestly, some of them seem incredibly difficult to pull off in the real world.
The alternatives do require stepping away from the frictionless digital world and re-engaging with complex and often really uncomfortable human systems.
Yeah.
The standard playbook in our sources includes seeking community assistance programs or applying through a local credit union, which, by the way, often cap interest rates by law.
That's good to know.
Or obviously liquidating any existing savings you might have.
See, the savings one is frustratingly obvious, but I know people who will literally take out a high-interest loan just to avoid draining their savings account.
Yeah.
It's like a mental accounting fallacy. They want to feel like they still have a safety net, even if they are paying 400% interest just to protect it.
It is completely irrational, but the psychology of protecting a perceived asset while taking on a toxic liability is a very well-documented behavioral trap.
Makes sense.
However, the most potent alternatives in the playbook actually involve managing the debt you already carry rather than acquiring brand new debt.
Okay. How does that work?
The specific guidance is to proactively contact your current creditors and service providers to negotiate due dates or set up hardship payment plans.
Okay, I have to challenge the viability of this.
Go for it.
I am looking at my monthly budget. Let's say I need that $900 for the mechanic, so I decide, you know what, I'm just not going to pay my electric bill and my credit card bill this month.
Okay.
I just don't buy that I can call up a massive faceless utility corporation, tell them I'm broke, and have them cheerfully move my due date without severe consequences. Like, they're just going to shut off my power.
Your skepticism is completely rational, but it ignores the underlying economic reality of the utility company or the credit card issuer.
This is.
It actually costs those massive corporations a significant amount of money to send an account to collections, to dispatch someone to turn off your service, and to process defaults.
Oh, right.
It is far cheaper for their bottom line to just put an account on a 30-day hardship hold or split a payment over 3 months than it is to lose you as a performing asset entirely.
That makes total sense. So what does that phone call actually sound like? Like, what is the mechanic of making that happen?
So it requires calling the customer retention or hardship department before the payment is actually late?
Before it's late, that's key.
Exactly. Once the bill is past due, the automated penalty systems take over, and it's much harder. But if you call, say, 5 days before the due date and state very clearly, I have experienced an unexpected financial emergency. I cannot make the full payment on the 15th. What are my options for forbearance or a split payment plan?
Just like that.
Just like that. The vast majority of these institutions have standard operating procedures specifically designed to accommodate you.
It's such a fascinating contrast, really, because clicking a button on a sleek app to take on a predatory loan, it's a quiet, secret transaction.
Nobody has to know.
Exactly. But calling the electric company requires vocalizing your failure. You actually have to admit out loud to a complete stranger that you don't have enough money to survive the week.
And that behavioral gap is entirely driven by shame. We are heavily conditioned to avoid interpersonal friction, especially when it comes to any kind of financial inadequacy.
Wow, yeah.
And online loan marketplaces monetize that exact shame. Consumers will willingly pay exorbitant interest rates and massive hidden fees simply to avoid the embarrassment of asking a utility representative for a 30-day extension.
That is so dark, but it's so true.
It really is. But by reframing that phone call not as a personal failure, but as a strategic financial negotiation, you can free up the cash flow you need for the emergency without introducing a toxic new liability into your life.
The difference between pausing the money you already owe versus feeding a brand new, highly aggressive debt machine.
Exactly. When you look at the totality of the ecosystem we've discussed today, the lead generation marketplaces, the algorithmic scanning of your checking account, the front-loaded origination fees, the overarching lesson is that emergency capital is never truly frictionless.
Right, the friction just gets moved.
Exactly. The friction is just shifted from the application process to the back-end repayment schedule.
So if you find yourself staring at one of these marketplace offers, the defensive strategy is actually pretty clear. You use the platform's ability to show you multiple offers, sure, but you strip away the marketing.
Ignore the bright colors.
Right. You look purely at the math, compare the origination fees, calculate the total repayment amount, and borrow absolutely nothing beyond the exact dollar figure required to neutralize the immediate crisis.
Yes.
If the car repair is $900, you do not accept the $1,200 loan offer just to have some breathing room. That breathing room will literally suffocate you in interest.
The discipline required to borrow the minimum amount is immense. It really is. But it is the only way to utilize these tools without being completely consumed by them.
Absolutely.
However, looking at the mechanics of how these alternative data lenders operate raises a much larger structural question about the future of finance as a whole.
Oh, well, where is this technology actually taking us?
Think about it. We have spent decades complaining about the tyranny of the 3-digit FICO score, a slow, opaque number that completely dictated our financial lives.
And people hate it.
They despise it. So now we are seeing the rise of an alternative system that ignores that number entirely. But the replacement is an algorithm that requires 247 read-only access to the minute-by-minute transactional reality of your checking account.
Oh, wow.
It evaluates how much you spend at the grocery store, how often your balance dips below $50, and the exact hour your paycheck clears.
So we basically traded a historical report card for continuous real-time surveillance of our daily habits.
Exactly. If the lending industry continues to move aggressively toward alternative data, The definition of creditworthiness will completely transform. It will no longer be about your ability to manage debt over years. It will be a real-time behavioral judgment of your daily lifestyle.
That's intense.
The question you will have to answer is whether the instantaneous convenience of a loan marketplace is worth granting a third-party algorithm a permanent window into your most intimate financial behaviors.
That is an incredibly heavy thought to carry into the future, but it's so important. The next time you find yourself scrolling late at night, feeling the panic of an unexpected expense, just remember the mechanics operating behind the screen.
Yep.
Remember the cost of the printer ink, the reality of the bidding war for your data, and the real power of just making a simple phone call to negotiate a due date. Take a breath, do the math, and protect your future self from a temporary crisis. Thank you so much for joining us on this deep dive. Stay curious, stay informed, and we will talk to you next time.